Okay, still continuing on the topic, investment securities. Like I was saying in my previous clip, we were looking at the functions of GSE, and I said small investors are invited to take part in the economy of a country through buying and selling of shares. And second to the last one, they actually help to regulate market for dealing with shares, plans, researches, and advices on investment possibilities. So we'll be looking at different investment opportunities businesses can choose depending on the type of risk, depending on the the rate, which is the interest rate. Businesses needs to choose the best investment opportunities for them. And the first one we'll be looking at, we have number one is the government retail bond, which is the government RSA retail savings bond. And the South African government offers SA South African citizens the opportunity to invest in savings bond to encourage saving. And we will speak more about the government retail bond. And you can get the government retail bond in the post office. That is where it is being purchased. Then number two, we have a unit trust. What is a unit trust? It is a collection of investment options method made up of shares in different companies. When you're talking of the word that unit, it means one. And the investment of a number of investors are put together in a unit trust fund managed by a fund or a portfolio manager or an expert. We also talk about unit trust. You can buy unit trust from different companies, and it's going to be managed by an expert who is going to monitor the portfolio for you. And number three, we've got shares. A share is a portion of ownership of a company and is sold to shareholders in form of a share. So share means you put in your money, that is you investing in a company, which makes you a shareholder of that company. And number five, we have what we refer to as a fixed deposit. When you're talking about a fixed deposit, it's a conservative method of investment at a fixed rate for a fixed period of time at a financial institution or at a financial or a bank. So when you're talking of a fixed deposit, that one is being done in the bank, and you have to put in your money for a period of time at a fixed rate at a fixed period of time. Maybe it has to be for 5 years, so which means you're not going to have access to that funds within the next 5 years, and at the same time you're going to be given an interest at a fixed rate. Maybe it's going to be 9% or it's going to be 10%, based on what the bank is willing to offer you. And at the same time, if the bank is going to offer you any interest rate, it has to be a rate that is much higher than the inflation rate of a country. And we have a managed portfolio. An investor instructs a financial institution, a bank, or a financial advisor to manage use of various investment assets in one portfolio. Then we also have a debentures, which we're going to speak about. It is used to raise borrowed capital from a public, and most types of debentures can be traded on the JSE. And also the lender or the debenture holder agrees to lend money to the company subject to certain conditions for a certain time. Then we have fixed property. Buying a house or a piece of land is usually suitable as a long-term investment only. So we'll be looking at all those investment opportunities one by one. And we also have on page 72, return on property is earned in form of a rental, a sale, a capital gains at higher price than what was bought for, including the transfer of cost in taxes. Then we have mutual funds, or what we refer to as a stokvel, an informal savings scheme to which a relatively small group of people contribute. A stokvel is usually managed by a trustworthy chairman or a treasurer who will be responsible for keeping records and managing the bank account. I think a lot of people do that stokvel, and sometimes we do see them on the television, and they tell us how it is being done, how it is being managed. And we also have a business venture or a venture capital. A venture capital is given by an investor businesses to start up, expand a business in return to have a share in the new or an expanded business. I think this is one of the great 10 topic whereby we're looking at when you're starting a business, how can you get capital? And one way is by having what a venture capital. So venture capital means someone, an investor, putting money into your business with the expectation of getting an interest on that business. So that is the example of a venture capital. So a venture capital can be used when you are starting a business, a new business, or if you want to expand your business and you are short of capital. So which means someone that is interested in your business can decide to put in money into that business and getting an interest in return for putting money in your business. And number 7, we have endowment or life insurance policies. It is a monthly payment to an insurance company with the expectancy of receiving a predetermined amount on a date in a future. So when you put your money in endowment or life insurance policy, there's obviously more that you get in the nearest future. And we have retirement annuities. It's also a monthly payment to an insurance company in return for an amount of money at a retirement age. So retirement annuities, you can only get your payout at your retirement age, which is going to be 65. Then we also have what we refer to as a 32-day notice account, or we call it a call deposit. It is money that is being invested at a fixed rate in terms like maybe like 9% or 10%, although withdrawals may be made provided the bank is given what? A 32 days notice of the withdrawal. So which means for that form of investment, you can actually put your money at a fixed rate for a certain time. But before that money can be withdrawn, you actually need to give 32 days notice withdrawal to the bank. Yeah. And there is an activity on page 73. I actually want you to read that. I actually want you to cover those answers and just try your knowledge and see if you actually know what the topic is all about. Then we're going to look at the risk factor for each of the investment opportunity. Remember, starting a business is a risk. Investing your money in any business opportunity or in any investment is a big risk. Risk in what sense? No one gives you the assurance that, okay, you're going to make profit. So some of these business opportunities or form of investment has low risk. So we'll be looking at the low risk. We'll be looking at high risk, and we also have some that can be what? A medium risk, like it's actually in between. So the first business investment opportunity we'll be looking at is the government retail bond, which is the RSA retail savings bond. What is the risk factor if you put your money in the government retail bond? Number one, it has no risk. I want you to actually correct that. It has what? No risk, not low risk. It has no risk. It's one of the best investments you can put your money into. And you check your focus textbook, it speaks more about the government retail bond. It has no risk, not low risk. It has no risk. It is an investment which is made in the government, who is unlikely to disappear or to go bankrupt. So which means the government cannot disappear, the government cannot run away, and at the same time the government can never go bankrupt. So which means they're actually giving you a guarantee that you will always get a return on your investment if you put your money or you invest with the government retail bond. Number 2, it is a safe investment as it cannot be sold on an open market, not exposed to a market risk. You can only buy that in the post office, and it's well managed. The portfolio is well managed, is not exposed to the market, and they cannot go bankrupt. So it's a very good form of investment. It has no risk, and there is a guarantee that you always get a return. Number two, we have a unit trust. What kind of risk factor does a unit trust have? Investments may be made in high and low risk shares, which spread the risk throughout the fund and lower risk for the investors. So when you're talking of a unit trust, what kind of risk does it have? It actually have a low risk, because you actually buying shares from different companies. So when you're talking of a unit trust, it means that I've got 100,000 rand, then I buy a unit trust by Sanlam, I buy a unit trust from Old Mutual, I buy a unit trust from Standard Bank, I buy a unit trust from ABSA. I'm buying them bit by bit all over. That is what we refer to as what? A unit trust. So what kind of risk does it have? So which means I can even decide to buy in a different sector just to minimize my risk. So which means I've got shares buying in the primary sector. I buy shares in a company under the secondary sector. I buy shares in a company under the tertiary sector. It means I'm minimizing my risk, which means if the share I have in any primary sector business is not functioning properly, obviously that in the secondary sector is going to have a good interest, or that in the tertiary is going to have a good interest. So when you're talking of a unit trust, it has close to low risk, or we can say it has what? A medium risk, because every of my investment are being spread all over. I'm not buying it in a place whereby, maybe let's take for example, I'm buying it in a bank and now the banking sector is not functioning properly. It means my investment is going down the drain. But in a situation whereby I decided to spread my portfolio, I'm buying a unit instead of buying 10,000 in one business. I decided to split my 10,000 into 1,000 each, spreading it into 10 different places. It means I'm minimizing my risk, which means if one is not being of a good return to me, another one would be a good return to me. So which means a unit trust is actually a medium to a low risk. And number three, we have shares. Shares have low, medium risk over a long term, depending on the type of share that you're buying. So we have different type of share. So what is the risk factor of a share? A share can have low to medium. Likewise, the unit trust. So I actually want you to actually highlight that. But remember, we have different types of shares. We will be talking about it. Depending on the kind of share you buy, the kind of share you buy determines the kind of risk you're going to have. And ordinary shares have the highest risk, as the investor may lose the full part of the investment when the company is being dissolved, going bankrupt, or it is being liquidated. And we have preference shares, so which means we have two types of shares that you can buy in a business. You can decide to go for